Imagine the sexy Lamborghini Aventador you have always had your eye on is going to double in its value over the next 3 months. You don't have all the cash to buy it today, but you really want to lock in the price. I give you the option of putting down $5,000 as a deposit and lock in the current price, where you can buy it over the next 3 months for the same price no matter what the market price is. That essentially, Plutus people, is what an option is. And today, staying true to our channel, we're going to make it very simple for you to understand options as an investment strategy. Plutus people, we're ready to jump headfirst into the world of derivatives. A derivative is a fancy term to basically say that the value of an asset is directly linked to an underlying asset. So we're going to talk about what an option is. An option is a contract that gives the buyer the ability or option, but no obligation, to buy in the case of a call or sell in the case of a put the underlying asset at an agreed upon price on or before a certain date, or expiration as we like to call it. People use options to generate income, hedge, and protect themselves against risk. Typically, an option contract controls 100 stocks of an underlying. This typically works for stocks, but an option can be written on any underlying asset. So from commodities to currency to what have you. As we understand what an option is, we're going to use a very simple real-life example to make it very, very easy for our viewers to understand. So we're going to be talking about a call option. The best summary that I found for what a call option is, think of call option as a down payment. So I have a friend named Nitin, and he has made his appearance on this channel before, but he makes a comeback. He has a nightclub in Banff that he's running, and it's going really, really well. Abdul comes along and thinks that he can open a McDonald's close to that nightclub in order to capture the late night crowd. However, Moritz wants to ruin their party and wants to demolish this nightclub and open a parking garage there instead. Now, Maninder, who is an investor, looks at this nightclub and thinks that this is a great investment opportunity. So he comes up to Nitin and tells him, Nitin, I really want to buy this nightclub. I want to buy it for $500,000. Now, Nitin likes the price, but Manny tells him that he does not have all the cash up front. So they strike a deal. Nitin gives him the option of buying this nightclub at $500,000 over the next 3 months, and for this option, Manny has to give Nitin a deposit of $10,000. So what it essentially means is that in 3 months' time, Manny can buy the nightclub at $500,000 no matter what the market price is. And the role of Moritz to demolish the nightclub and open a parking garage, and Abdul opening a McDonald's right next to it, comes into play in terms of adding or decreasing the value of the nightclub. So let's say that Abdul succeeds in 3 months to open a McDonald's right next to the nightclub. This increases the price of the nightclub itself. However, Manny has locked in the price. So in the first scenario, the McDonald's opens and the price of the nightclub rises to $750,000. Manny exercises option of buying the nightclub at $500,000, netting him a nice profit of $250,000 because the market price of the nightclub is $750,000 at this time. Scenario 2, Moritz gets his way and demolishes that nightclub, and the value of that nightclub, because it doesn't exist anymore, goes down to zero. Manny's maximum loss is the down payment that he has paid to Nitin, which is called the premium of having that option or having that contract. So Manny just walks away from the whole deal. He has just lost the $10,000 premium, but he doesn't have any obligation to buy that underlying asset or the nightclub. The third scenario that can happen is that neither Moritz nor Abdul are successful in either increasing or decreasing the value of the nightclub, and the nightclub is still $500,000. So Manny has the choice of exercising that option and buying the nightclub at $500,000, or still walking away with only losing his $10,000 at the end of the 3 months. The 3 month in this case was the expiration date or the expiry of the option. The $10,000 down payment was the premium of the call option, and nightclub was the underlying asset. And the strike price in this case, when we'll walk through the options, we'll look at strike price. The strike price in this case was $500,000 that was agreed upon. So that in a nutshell is a real life example of what a call option contract is. We're going to apply what we have learned about what a call option is through our nightclub in Banff example to an actual stock. So here we have Apple, and it is trading at $119.90. Just for simplicity, we're going to say it's trading at $119. Here we have the expiry date, the strike price, and the premium, which is the down payment that we have to pay to reserve that price for us until April 1st. So my prediction is that Apple is going to close higher than $120 by April 1st, because a call option is a bullish strategy. Bullish meaning you believe that the stock will be going up in value. So you pay $100 in premium to a market maker to hold the price of Apple for you at $120, no matter what the price is at the end of expiry on April 1st. So talking back to our scenarios, first scenario, at the end of your expiry on April 1st, Apple is trading at $121. So you bought the call option at $119, now it's up by $2 a stock, but your option contract gave you control of 100 shares. So your profit is $200 minus the premium you paid, which was $100. So you netted $100 if the stock closed at $121. Let's say that your stock just ended at $119. Now you don't have the obligation to buy those 100 shares. You can just walk away losing only the premium, the $100. And lastly, the last option is that the stock closes at $118. So it has gone completely the opposite of what you were hoping for. But then again, you don't have an obligation to buy 100 shares. You just lose the premium that you made as a down payment. So that in essence is what the three scenarios that can happen with a call option. But and as Plutus people, we want to make money, and we hope that you bought this and Apple closed at $125, netting you a good $500, because from $119 to $125, the difference is $6. Quickly, 6 times 100 is $600 minus the $100 you paid as your premium. So $500 profit. There you have it. Call options explained. To round up our video, as always, here's the ticker of the week. I'm very excited to share this ticker of the week because with the news of Visa accepting Bitcoin, Visa I think is going to be a powerhouse in payment processing, more so than it already is. So the ticker of the week is V and Visa. I heard about the Department of Justice probe and I opened a position in Visa because I knew that the selling was an overblown response to it. Visa was down 5%. I got in and it's already recovered to its original level. And I think there is a lot of upside just because of it coming with and joining forces with Bitcoin. As always, please let us know what your thoughts are on the ticker of the week. I'm very, very excited to tell you that there's going to be an amazing video that's coming out, and it's a little bit of a different take on the financial videos that we have been doing so far. So stay tuned for that, please.